Welcome to Shareholder Primacy from Free Float Media, a podcast about activist investing, securities law, and all the ways the financial and legal worlds intersect and collide in real life. I'm here again with Ann Lipton, law professor at Tulane in New Orleans, who teaches and researches securities and business law. She holds up the legal end of our little podcast enterprise.
And that's Mike Levin, an activist investor who lives and works in Chicago. He covers the financial side of our podcast.
Well, we got a couple of fun things to talk about, and if we have some time, let's get a status on what's going on in Delaware.
Okay, we can do that.
I know there's all sorts of goings and comings, and the status of things, but let's kind of hold that till the end because I think there's some developments that we can at least anticipate. But in the meantime, today let's talk a little bit about private companies. There's a lot of debate about public to private and how many IPOs there are and so on and so forth. But we'll focus on a more specific issue about how they can kind of stay private, basically by manipulating shareholder counts to avoid getting into the definition of what it means to be a public company under various state and federal laws. How's that sound?
That sounds great. And as proxy season is upon us, it's the time for disgruntled shareholders to think about withholding votes from incumbent company directors. So we'll talk about whether that's a good idea and how it works.
Yes, we will. So, Ann, let's think about private companies for a little bit. There's been a lot of some articles and research and debate and discussion about the big AI startups, but maybe even some others. The big AI startups like OpenAI, Anthropic. A lot of these newer kind of companies are raising capital in interesting and potentially unusual ways. As we kind of hinted at, the number of conventional straight IPOs is way down, and isn't expected to improve anytime soon. But there are still companies going, that are raising money. They have capital needs, and in particular, there was this huge bubble of SPVs, special purpose vehicles, that kind of were being used to help a lot of these companies get the capital they need for investment and for operations and so forth. Let's talk a little bit about that, and let's first sort of lay some groundwork about how that works outside of an IPO and why what we're starting to see might be a little unusual.
Yeah. So a couple weeks ago, we had that show where we talked about how companies are able to stay private for long periods of time so they can raise capital without becoming obligated to make regular securities filings.
Right.
And so what's going on with the AI companies and these SPVs, special purpose vehicles, it's really Exhibit A for how that works. So normally you have to start making public reports, securities filings, whenever you sell securities to the public, when they're in public hands. The theory being that public dispersed investors don't have a great way to obtain information on their own. They can't talk to insiders. They have no contact with management. They can't figure out how to value their holdings. And dispersed investors in particular have a basic collective action problem. They have no bargaining power to force management to make adequate disclosures. So that's what the securities laws are supposed to deal with, that once the securities are sold to the public, the law forces the company to start disclosing publicly. And that just raises the question, what's public?
What does the public mean? Exactly. And the public here, when I sometimes think of public, I think of like widows and orphans and individuals and so forth. But the public is also like institutions.
It can be.
Right, of course. And, like BlackRock and State Street and Vanguard, they have their own special departments for investing in private companies, but all the stock they own, they're just like widows and orphans themselves. They're public shareholders of publicly traded equities.
Right. Yeah. And so we get to this question of what does it mean when, how are we going to define the point when a company has sold shares to the public so that they have to make public reporting? And usually if they sell to a small group of very wealthy investors, that's not going to be considered public. That's private. Those people, they can bargain for the information they need. They have direct contact with the issuer. It doesn't trigger reporting obligations. But when the company is a class of equity that's held by more than 2,000 people, not counting employees who receive stock compensation, 2,000 is the magic number, 2,000 persons, now that's public and you have to start reporting, which means startup companies, they try very hard that they don't bust that 2,000 person cap.
All right. So it's defined in terms of a sheer count of, at least very conventionally under these, and this is SEC rules.
This is statute and SEC rules.
Right. Very conventionally is if you have more than 2,000 individual, separate, discrete shareholders, you are declared to be public and then subject to disclosure and also registration and all sorts of other fun stuff that the SEC uses to protect those 2,000 or more people's interests in your company. All right, go ahead.
Right. So then now we have to define what we mean by person. Because a person
interesting.
is not necessarily like a human person. The legal term is natural person. It doesn't have to be a natural person. So imagine a venture capital fund. Lots of people invest in the fund, wealthy people, pension funds, those kinds of investors. They invest in the venture capital fund, and then the fund invests in a startup. We could look through to the fund's owners, but we don't. The fund is considered a single investor. So technically, the fund could have raised investment from a lot of different people. But
they could have 2,000 of their own investors.
That's exactly it. They could have 2,000 of their own, but they're considered private. And they invest in a startup, and now the startup, so when the fund invests in a startup, and now its startup has only got one investor, the venture capital fund, and it has room for 1,999 more people, and for a class of equity securities. So in this way, companies can stay private, but functionally aggregate the investment of hundreds or thousands of people without busting that 2,000 person cap. But problems started occurring because, and now 2010, 2012, 2013, we first started to see the rise of these very hot unicorn startups that weren't going public. And moderately wealthy people, not the super wealthy, wanted access to these investments. And the startups wouldn't take their money because, even if it was tens of thousands of dollars, it still was too low a number. They'd have to aggregate too many people, and they'd bust the cap. And actually, in those years, the cap was 500. It was raised to 2,000 in 2012. So in this period, in order to allow these moderately wealthy people to get access to these startups, some brokers started creating SPVs, special purpose vehicles, that would take investment from a lot of individual moderately wealthy investors, pool their holdings, and use those to make one large investment in a pre-IPO company. The SPV would count as a single investor, like one little LLC on the cap table of the company. And then these smaller investors would now own shares of the SPV, whose only asset was one pre-IPO company. So Merrill Lynch and Morgan Stanley did this with Uber. They created these SPVs that held Uber shares and then gave their wealthy individual clients the opportunity to buy shares in the SPV, like a perk, like we're
right. It's just like it used to be you'd get IPO allocations from these folks.
Yeah.
This is in the 90s and the 20,000. Right. Well, this is when there was big IPOs. There was a ton of these. This is when Facebook was going public and all those kind of things. But now, instead of giving you an allocation of an IPO, they're giving you a piece of this SPV.
That was right. That was the idea. So but you got to understand that's different fundamentally from what VC does, because venture capital, it takes investor money, but then it actually manages it. Like they figure out what companies to invest in. They negotiate for financial preferences. They get board seats or governance rights. They profit. They themselves are also going to profit from a share of the fund's investment. When one fund might hold shares in multiple companies. So venture capital funds are really managed on behalf of their investors. But the SPVs are different. No one's really managing them on behalf of the end investors. They're just pass-through vehicles. So these end investors, these moderately wealthy individuals, have a chance to invest in a startup that they think sounds good. And the investors are charged a fee by the SPV for this service. They can't bargain with the startup because they have no relationship with the startup. They don't get any information. They don't even know who it is
sometimes. When they first raised the fund, right?
Well, no. For an SPV, no. Because the whole point of this SPV is that this is like your chance for a millionaire but not billionaire to get a share of Uber shares. So they know that they're going to and what they're investing in, but they're not. It's not like the SPV is managing for them. The point of buying a share of this SPV is so that they can get access to Uber shares. And there's a fee. Whoever organizes the SPV gets a fee, but they don't get any information about the startup. The SPVs aren't passing information about the startup to their end users. They don't have any governance rights. So investors in the SPV are just a lot more vulnerable than investors in VC funds. But this is a way that startups can expand their investor base massively, even though they're formally staying below that 2,000 person cap.
Oh, so you're investing if you're a dentist.
Yeah, exactly. Or
wealthy dentists. One of those people, doctor. We used to call it doctor money. If you really had a bad investment, you were trying to go to investment banks. Used to go to a medical conference.
Oh yes, exactly.
So sorry. Anyway.
No, that's exactly right.
So they'd be investing in the SPV, which in turn invests in this hot startup without any of the protections of disclosure
Right, because if it's a VC fund, they're really managing and watching over the startup, but that is not what an SPV is.
This is they're just basically ministering it rather than kind of actively
administering
supervising.
This, exactly.
All right, so that's been going on. That's kind of how some of the AI companies or whatever.
Yeah. Well, yeah. So I mean, so the problem here, obviously, is that this is well beyond what was intended when they were supposed to have this 2,000 person cap. So back in 2012, when the cap was first raised from 500 to 2,000, the SEC put out this report. Well, what do we think about this? And the report concluded, look, if investors themselves are organizing these vehicles, or their brokers are organizing these vehicles, because the investors really, really want a chance to invest in a startup, and the vehicles aren't really controlled by the startup or startup insiders or by the controlling shareholders of the startup, then it's not a problem. The investors are the ones who benefit from information, and if they want to take their chances, so be it. But the SEC said it's not going to be okay if the startup is itself using an SPV as a way of evading the cap.
Oh, okay.
So that was fine. That was in 2012. But since then, the practice has really just exploded. And by the way,
it's taken off.
It's taken off. And I have to mention there's a paper by Anat Allenbeck and John Livingston that talk about how the numbers have changed. But the issue is in 2012, the securities laws actually loosened in a lot of ways. So after that, startups started getting a lot bigger and staying private even longer. And they issue all this stock to their employees as compensation that doesn't count towards the 2,000
towards the 2,000 cap, right? Yeah.
But if the employees sell, now that stock does count towards the cap. So imagine you're an employee. You have 500 shares. You don't count as a person. But if you sell your 500 shares to some other investor, that investor is a person.
It counts. How about if you sell a fraction?
If you sell, that's exactly it. If I sell 250 blocks, now that's 2 investors. So employees, when they want to sell their shares, they're creating more investors for the startup.
Creating more persons.
Exactly. And the longer the company stays private, the more employees really want to sell, because the whole point for employees is they're going to they need to pay rent, they need to buy groceries, they need money.
Or they need to diversify.
Well, I don't know that they're I honestly don't think startup employees are necessary. They should be thinking about diversification, but mostly they're just thinking, I want to pay the rent. So they have to sell, and there's pressure to find a way to allow employees to do that without busting the 2,000 cap.
Right.
Plus, in the AI space, there's this desperate need for capital because computing power is so expensive. So now, the practice of using SPVs to roll up the investments of moderately wealthy people who can afford to buy in at $10,000 or $50,000, that's really taken off.
All right. So what's the presumably some of these machinations are getting the attention of the SEC?
I would hope so. But I mean, really at this point, it's this wild west. So you might have, I guess maybe brokers are going to doctors' conferences, as you said, but
that's what I'm saying. Yeah, right.
Yeah. But one really interesting thing, I was researching this, I was prepping for my SecReg class, and I was on the website Start Engine. Do you know the website Start Engine? It's this
I've seen
website.
it. I haven't used it. Yeah.
Well, it's a website that allows small retail investors to buy shares in pre-IPO companies. That these are being sold in a different way. So there are these tiny little micro businesses that are allowed to raise small amounts of capital from retail investors without formally holding an IPO. And Start Engine is a website that hosts a lot of these little tiny offerings. But Start Engine does more than that. Start Engine creates these SPVs, which it advertises. Oh,
it actually creates the entities.
Some of them, yeah. So if you can go to Start Engine now, and it's got an SPV for Anthropic, for Ripple, for Kraken, for Perplexity AI.
Oh, now you could go there and find
there. No, actually, right now, all of them are closed, but you can get on a wait list. You can pay hundreds of dollars to get on a wait list, and then I guess when they get enough investors together, they'll do another SPV investment in one of these companies. You have to be wealthy. There's a wealth requirement, but it's moderately wealthy. So it's allowing the public to invest with virtually no rights and no information. And I don't necessarily think Start Engine is a big driver here, but it kind of amazes me that you can just go to this website and these SPVs are available. But also, probably more traditional brokers are contacting their clients. And it all raises the exact same kind of problems that the securities laws were supposed to address. The investors have no way of knowing if these are good valuations. They're too dispersed and too removed from the startup to bargain for information. They're uncounseled. They have no protections. And they aren't investing in the startup, just the vehicle. So they don't even have the state law protections that a shareholder would have. No one owes them fiduciary duties. They don't have books and records rights. None of that.
Oh, because the SPV is standing in between between the investors.
Exactly.
So the entity that has those rights is the SPV, but they're never going to exercise them.
They're never going to exercise them. And the SPV, often it's an SPV that has shares in another SPV, which is then invested in the underlying company.
So there's like three layers of
exactly.
Right,
So, but this is the part that amazes me. Sometimes the venture capital funds that invest in the startup, some of them are also organizing SPVs so they can raise money from a broader group of investors. But these venture capitalists, they often have very close relationships with the startup. Like the New York Times reported that one VC firm worked with Anthropic's head of business development to set up an SPV. Business Insider said that Elon Musk's company, XAI, actually participated in solicitations for an SPV. So you see where I'm going with this. In 2012, the SEC kind of shrugged over the idea that some investors might on their own form an SPV to get access to a startup. But now it's this Wild West where it's becoming an ordinary part of startup funding. And we have these very cozy relationships between the startup and the SPV sponsor. And it starts to look to me like what the SEC was warning against in 2012, that it would violate the rules if the companies themselves organized SPVs as a way to get around the cap.
Right, so or as a way to do an IPO without complying with any of the IPO rules.
This is doing an IPO without doing an IPO. That's exactly the point.
Right, and keeps them private for longer or whatever.
Exactly.
But this is interesting because there's been this whole debate about why companies are staying private for longer and so forth, and not taking public money, and the reason in part has to do with how we're redefining what it means to be private and public.
Exactly. If you if you do it through multiple levels of SPVs, then suddenly it doesn't count as public anymore.
Right. Wow. Do we have any expectation? I think I know the answer. Is there any expectation that today's SEC is going to try to address this?
No. There's no expectation that today's SEC is going to address it because Republican administrations in general tend to be more laissez-faire about these things. They want to let investors make their own decisions without any regulatory protections. Sure. So I expect the SEC to kind of open these opportunities up to even more people, and I think that's a problem, partly because of what we talked about when we talked about this before. These funding mechanisms allow really big, socially important companies to operate in a black box, but also I think
without disclosure,
that would benefit the rest of the world. But also, I don't think these moderately wealthy retail investors are particularly sophisticated. They don't have information rights. They don't have governance rights. They can't sue. They sign arbitration agreements. So they're paying these opaque fees that vary from SPV to SPV, and it's just a recipe for a lot of losses down the line. And that's bad for these investors individually. And it's just, my general thing. It's a societal misallocation of capital. We can't be sure we're directing resources to the best businesses. We created a system.
And the potentials for fraud seem potentially rich.
Yes. And that I think the SEC will enforce. But by the time they get to it, who knows how much they recover. And I think, this is just a place where the securities laws are encouraging a kind of investment that's based on vibes. And that's a problem.
Right. Oh, yeah, I see. Oh, wow. Yeah, again, hopefully you can tell I've been thinking, some about this whole public-private, but the idea of using regulatory sleight of hand to try to change what it means to be public and private as a way to stay private was not something I saw coming. So, wow. All right. What do you think we take a little break here for a little bit?
Okay.
And we can come back in a little while to talk about withhold and vote no campaigns here at Shareholder Primacy.
Shareholder Primacy is brought to you by FreeFlowAnalytics.com, the only free database of corporate directors, their influence, and their performance. If you own a stock or retirement plan, go to FreeFlowAnalytics.com and look up which of your elected directors are performing well and which aren't. Use your vote in the alternative democracy and get your data at freeflowanalytics.com. Now, back to the show.
Welcome back to Shareholder Primacy. I'm Ann Lipton here with Mike Levin. So, Mike, what does it mean to vote no or withhold a vote?
Okay.
We're talking about director elections. Annual elections for directors. What is voting no or withholding?
Voting no means voting no. It means declining to support incumbents in a director election. So, I talk a lot, and you and I talk offline or whatever about proxy contests where folks like me find director candidates to compete with the existing candidate or existing incumbents on a board. Well, if you're not doing that, and again, that only happens, 50 times a year or far less. All right. The vast majority of director elections are uncontested. Well, you're still, and that doesn't mean that the vast majority of shareholders are deliriously happy with what's going on at a company. So sometimes they express their dissatisfaction by sort of voting against or with abstaining or whatever. There's various ways to express this, the incumbents, and just basically declining to support them.
So there's no opposing director running, but there's nobody else on the table. Somebody has to fill the slot, but they're just voting no anyway.
Is voting no, and so there's a couple mechanically. There's usually in those situations, if you're kind of filling out your proxy card or your ballot, you usually have two choices: vote yes or withhold. So and withhold is an affirmative act. It's not the same as abstaining. And that kind of matters in terms of calculating denominators here. But it basically means checking off the withhold box. And what's so interesting is that, it becomes, there's a lot of chatter at certain companies about we're going to start a withhold campaign. We're unhappy with this company, so we're going to do a vote no. And it's always kind of puzzled me because it's a really kind of a weak way to influence a board to try to exert your rights. And so that was what I was kind of thinking about as we explore this is how is it weak and why would people do it anyway? So that was kind of where we're going with this.
So I mean, but why? I mean, is it better than like nothing? I mean, it's expensive to run a proxy contest, but at least.
Oh yeah, wait a second. One of the advantages is it's pretty cheap to do this. But again, it's for reasons we can talk about it. It's pretty ineffective. Now let's make it clear that we're not talking about when proxy advisors submit a withhold recommendation.
So wait, why is that different?
Because they frequently do that. Because some board has violated a policy, some board didn't act properly on a, adverse say-on pay vote, you're supposed to withhold for the comp committee chair. That happens a lot. And you'll get a proxy advisor that says, I don't think you should support this person. And plenty of people, then follow that. What I'm talking about is when an activist starts to advocate for a withhold. Or vote no, and that happens a little more frequently than people might expect. So there's at least 3 or 4 examples in very recent past. So I don't even remember Blackwell's. We've talked about them, about Disney and so forth. They're this kind of idiosyncratic hedge fund that kind of makes trouble in various ways for companies. So they actively advocated to withhold votes at Ashford Hospitality Trust, one of their principal investments. This is just last year, 2024. And they were telling all of the shareholders to oppose, all 9 directors, and then 2 of those directors, the CEO and board chair, received actually under a majority.
Oh, wow. So that...
Yeah. And that triggered a mandatory resignation of those 2 losers, which the board then refused to accept. So that those guys are still on the board, even though they received less than majority, which is one of the problems we can sort of with this whole strategy. Some friends of mine at Legion Partners that I know, they actually actively opposed 2 directors at GES, Expedition Company, in 2022, and they received materially less support, but even got a majority, but it was a lot less than what other directors on the slate won. And then one of those folks actually did retire, so maybe there was a little bit of pressure that was put on them, but it was highly indirect. Okay. So anyway, there's examples of this at least a couple times a year, and there's a couple, that are kind of cooking right now where people are thinking of this kind of vote no idea. And there's a couple of ways that you can actually do it. Okay.
So
The first is basically just shouting from the rooftops, vote no, withhold. Usually accompanied by news releases and exempt solicitation filings. I can't remember the designation, PX, whatever it is, where you basically tell all the other shareholders, we're not soliciting your proxy, but we want you to vote no. Then you're kind of acting a little like the proxy advisors we talked about a little while ago.
Right.
You're just telling people that this board or these two directors are just bad news, so just oppose them and check off withhold, and we'll sort of see what happens. Okay? You can also solicit in opposition. So rather than just advocating that people should vote no, you can do a withhold solicitation.
So
Go ahead.
So you're like actually asking for their proxy, like an alternative computing
for the
proxy.
purpose of voting withhold.
Oh wow.
So you're gonna solicit the proxy, and you're gonna say, I'll vote for the auditor and so forth, all the other stuff that goes on. But when it comes to the directors, this is how I plan to vote your proxy if you appoint me proxy.
Now that sounds
and I'm
a
going
lot
to vote
more,
withhold for these three people.
And that sounds more expensive, but also more aggressive.
Yeah, exactly. And for all the same reasons we've talked about, when you're soliciting proxies, again, it's more aggressive. You got to hire a solicitor. You got to do all the kind of work. You gain a little bit of control over the proxy process relative to the company because you're holding the proxies and the company isn't. So you kind of know how people are voting. And it's a little more intense, but it's definitely, a much more affirmative way to try to influence things. So the two we just talked about, Blackwell's and Legion, they actually solicited proxies in opposition to at Ashford and at GES, and there's a couple others.
That does strike me like
Capital, right? Exactly. So this happens like once a year.
If you're gonna go like as far as actually soliciting proxies, but not propose an alternative candidate, that is a sort of odd.
Well, there's reasons kind of, and we've talked about that. That's kind of weak because if you actually succeed, in getting directors to. Right, to get far under a majority, either they have majority vote standard and they have to resign, and then you get what happened at Blackwell or at AHT where they just refuse resignation. And that happens a lot. That's what we call these zombie directors,
right? Who
are directors that received less than majority and either didn't resign or had to resign and they refused a resignation or whatever. Okay. So again, it's kind of a weak way to try to influence, though it does happen, occasionally, where, I'm familiar with at least one case at Kirkland, not Kirkland Brands from Costco, Kirkland Corporation, where there was a vote no, and the director received under majority and resigned, and then was replaced. So it does happen, but it's pretty like I said, it's not the most effective way. Now the reason people do this is it's kind of a little crazy. But frequently, they'll miss a deadline.
They missed a deadline for identifying an alternative.
Or for filing notice. Okay, so frequently, and this happens a little more because companies are starting to become more aggressive, like with advance notice.
Yeah.
So if they boot you from the advance notice, okay, boot you from being a candidate. Because using the advance notice bylaw, if you still want to try to put some pressure on the company, or sometimes people have said this to me, I just blew the deadline. I didn't know it was coming, or I didn't get it in time. I missed it by 2 days. That actually happens, believe it. So your next best choice, if you were kind of gearing up to try to oppose directors and so forth, your next best choice might be to continue to put pressure on the company using.
What kind of signal does that send to all the other shareholders? I'm the activist who missed the deadline.
Don't have quite your act together. Yeah, I know. It's not your proudest moment when it does that. But it also is a way to kind of assess shareholder sentiment.
Right. Yeah.
So if you actually want to go as far as soliciting proxies, for some funds it's not. If they were already planning on budgeting it and so forth, you might as well spend a little bit of money on that. It does put you in front of shareholders, and you can start to solicit their proxies and try to assess their their thoughts and feelings and opinions about the company. And it's, there's other ways to do it, but it's a good way to at least get people to kind of commit. If they're going to send you their
Right.
proxy to withhold, you kind of know where they're at. And so it's another way to put a little bit of pressure on a company. I've heard from people who have said, no, I don't want to go as, and I don't always understand this. I don't want to go as far as nominating directors myself. I don't want to be that much of a threat, but I'm just a little upset with the company enough to kind of try to advocate. And this is more the exempt solicitation than soliciting in opposition. I'm just a little upset, so I want to sort of send a signal. And again, I can think of more effective ways to send the signal, but again, for some, it could make some sense just to express a little bit of displeasure. Especially because, again, the mechanics of this are not trivial. I mean, getting people to actually, vote, withhold, and find the right, and not abstain, and answering all the questions. If you're going to do this just on an exempt basis and not solicit proxies, you don't have a proxy solicitor, and they're helping people fill out the proxy card. So it can get a little tricky. But again, it does have its uses. The uses aren't nearly as effective, or as we might say, powerful, as a real live proxy contest. But again, for someone who doesn't want to spend a ton of money on this, or who missed a deadline or something like that, it could have its place. So we're gonna. So there's already a couple of these that are kind of happening this proxy season, where I'm expecting to see a couple more. I haven't heard of anybody actually doing a withhold solicitation, but there'll be a few of these, and when you see them now, you kind of know what's kind of going on in the background.
Right.
Let's talk for a minute about what's going on in Delaware this week. And what we expect for next week. I know that, we talked, last time you and I talked, you were out running around at conferences for a couple weeks.
Yeah.
Go ahead.
Well, I mean, by the time this, reaches the airwaves, the situation may have changed again. But we are recording this, so let's just say this. We're recording this on a Sunday. Yeah. And it's going to be made public on a Wednesday. But at the time of this recording, so we had a show about a proposed law in Delaware, and
SB 21.
SB 21, and then the Corporate Law Council, which is basically of the Delaware State Bar Association's corporate law section. They got together and they made some changes to it, which are worth talking about at some point.
Right.
But they made some edits to it.
Right.
In some ways, they softened it. In some ways, they made it even more draconian.
Made it worse.
They made it worse in some ways, and they softened it in other ways. But that was voted on in the Delaware Senate and voted in favor.
And this is last week.
That was, yes. And I lose track of my weeks.
I think it was last. I'm almost sure it was last week.
Okay. And then it went to the Delaware House, where it was supposed to be voted on. It was voted out of committee, but they didn't actually vote on it. And probably because of the there's now just a terrific amount of lobbying on both sides. And we kind of expected that they were going to vote on it last Thursday, and they didn't. And at the same time, a new amendment was introduced, which may or may not be picked up, that would make it opt-in. It would essentially mean that instead of the new law applying automatically for every company incorporated in Delaware, it would only apply to companies that affirmatively had a shareholder vote in favor of it.
Cool.
Now the House has to consider, the Senate bill has to consider this amendment. We are expecting, very possibly, that there will be some kind of vote on Tuesday, which will be right by the time people hear this. It will have. We will know
if we follow the schedule,
yeah,
it'll be a day before this podcast posts.
Exactly. Right. But if the and either this House will vote in favor of the Senate version of the bill, in which case unquestionably the governor will sign it, yes, or the House will take up the amendment or make some changes, in which case it'll have to go back to the Senate, and it will still be.
So we may have another week or two of legislative back and forth.
They'll probably try to. Their whole thing is they want to get it done before most companies get their proxy statements out, because they're afraid that companies will otherwise vote to leave Delaware. So
they'll start putting this on company proxies.
One company actually, a REIT already did. So
who did? I'm sorry.
A REIT, the Simon.
Oh, a REIT. Yeah. Got it. Okay, got it.
Yeah. So Delaware's in a rush. Even if the House rejects the Senate version and amends it, I'm sure the Senate will take it up very quickly. And
Right.
so one way or another,
So
this will be resolved.
in addition to following the statutory changes that are being proposed, it sounds like you've been paying pretty close attention to the political.
Yeah, but
stuff.
I don't really have a whole lot of insight into Delaware politics. But there have been, but this is the thing. Usually you don't see a lot of politics surrounding corporate law amendments. It was last year there were some, and this year there are more. And this is new, that it's such a political process, which is
All right.
a pity.
Well, hopefully we'll know more, and we might the next time you and I are together talking, we may be talking about Senate Bill 21 and what it means for the world, right?
Yeah, exactly.
All right. Well, let's wait and see. We won't be. It sounds like we won't be waiting too long now. So,
Yeah.
all right. Let's wrap up. It's been great talking about public to private or private to public companies and withhold votes. And so we'll leave it there. This is Shareholder Primacy, hosted by Ann Lipton and me, Mike Levin. I'm an independent activist investor, an advisor to investors about their activist situations. Ann is the Michael M. Fleischman Professor in Business Law and Entrepreneurship at Tulane Law School and an affiliate of Tulane's Murphy Institute. You can find me, Mike, at theactivistinvestor.com and Ann at law.tulane.edu. Our podcast is produced and distributed by Free Float Media. Thanks for listening, and we'll talk again soon.